Sink or sell. The tough choice for Canadian homeowners in financial stress. The Canadian housing crisis. Understanding the struggles of homeowners and the looming market crash. The Canadian housing market has been experiencing tumultuous times due to a series of key interest rate hikes initiated by the Bank of Canada since March 2022. As the overnight rate reached 5%, the highest since 2001, homeowners across the country have been facing significant challenges in meeting their mortgage payments. This video and information discusses the intricacies of why some Canadian homeowners are financially stretched to the brink, explores the consequences of delayed actions, and discusses the potential risk of a housing market crash. The impact of interest rate hikes on homeowners. The successive interest rate increases by the Bank of Canada have led to a considerable rise in variable mortgage rates. For homeowners who took out variable rate mortgages, the impact has been profound, with their monthly mortgage payments increasing substantially. This sharp rise in payments has placed considerable financial strain on many families, affecting their ability to cover essential living expenses and engage in discretionary spending. Homeownership, once a symbol of stability and security, has become a source of stress and anxiety for some households. To illustrate this, let us consider the case of a family who purchased their home in September 2021 with a variable rate mortgage. At the time of purchase, their monthly payment was manageable. However, within just a year, their payment has skyrocketed, increasing by 72%. This rapid escalation has left homeowners struggling to make ends meet and has given rise to fears of potential defaults. Switching to fixed-rate mortgages. A temporary solution? In response to the rising interest rates, some homeowners are seeking solace in fixed-rate mortgage alternatives. The appeal of fixed-rate mortgages lies in their predictability and stability, providing homeowners with the assurance that their monthly payments will remain constant throughout the fixed term. However, this shift in preference from variable to fixed rates may not be a comprehensive solution to the mounting housing crisis. While fixed-rate mortgages offer short-term respite from escalating interest rates, they do not address the underlying issue of the broader housing market challenges. The rising costs of homeownership, coupled with the current economic climate, may result in limited demand for properties in the long run. Additionally, homeowners who have already chosen fixed-rate mortgages might face challenges in renegotiating their mortgages when the term expires, should interest rates continue to rise or even stay at their current levels. The risk of a housing market crash. A looming catastrophe. The confluence of factors, including sustained interest rate hikes, potential regulatory changes, and a shift towards fixed-rate mortgages, poses a substantial risk of a housing market crash in Canada. Here's a deeper exploration of the potential chain of events that could lead to this catastrophic scenario. Defaults and flood of listings. As homeowners find it increasingly challenging to sustain their mortgage payments, some may be left with no choice but to default on their loans. This could lead to a flood of properties being listed on the market by financially stressed homeowners looking to offload their homes. Excessive downward pressure on prices. The influx of listings will create an oversupply of homes, driving down demand and putting excessive downward pressure on property prices. Homeowners trying to sell their properties may find themselves in fierce competition, forcing them to lower their prices to attract potential buyers. Negative equity and financial strain. As property prices plummet, some homeowners may find themselves in negative equity, where the value of their home is less than the outstanding mortgage balance. This situation would exacerbate financial strain, making it even more challenging for homeowners to cope with their mortgage payments. Reduced consumer spending. The housing market crash could have broader implications for the Canadian economy. A significant decline in property values might lead to decreased consumer spending, as households may choose to tighten their belts amid economic uncertainty. Economic contraction and job losses. A housing market crash can trigger an economic downturn, leading to potential job losses in industries closely tied to real estate and construction. The ripple effect of job losses can further exacerbate the housing crisis, creating a vicious cycle of economic contraction. The Bank of Canada's ongoing interest rate hikes have created a challenging landscape for Canadian homeowners, particularly those with variable rate mortgages. As mortgage payments increase, homeowners find themselves in financial distress, trying to navigate the uncertainties of the housing market. While some homeowners have turned to fixed-rate mortgages for temporary relief, this may not be a comprehensive solution to the larger housing crisis. The potential for regulatory changes and the impending risk of a housing market crash loom large, necessitating proactive action by financially stressed homeowners. For those facing financial difficulties with their mortgage payments, selling their homes now may be a prudent move to avoid being caught in a flood of listings during a market downturn. By acting proactively, homeowners may have a better chance of securing a stable price for their property and alleviating the stress of holding onto a depreciating asset. The recent article in the Oakville News titled, "Homeowners Taking Drastic Measures to Pay Mortgages," discusses many of the same points mentioned earlier in this video and provides examples of how ordinary Canadians are being affected by these higher mortgage interest rates. Homeowners taking drastic measures to pay mortgages, Oakville News, July 28, 2023. In the article published in the Oakville News, the impact of the Bank of Canada's aggressive interest rate hikes on Canadian homeowners is thoroughly examined. Since March 2022, the central bank has raised key interest rates multiple times, leading to a series of consequences that have left thousands of home loan borrowers financially stretched and anxious. As of the latest report, the Bank of Canada raised interest rates for the 10th time early this month, pushing the overnight rate to an unprecedented 5%, the highest level since 2001. The effects of these rate increases have reverberated throughout society, with homeowners bearing a disproportionate burden. While some homeowners have opted to switch from variable rate mortgages to fixed-rate alternatives, others are grappling with the repercussions of struggling to meet their increasing mortgage payments. The uncertainty surrounding the popularity of variable mortgages and the rising preference for short-term fixed rates across Canada is a matter of ongoing debate. The personal stories of homeowners featured in the article provide a poignant insight into the real-life challenges they are facing. One homeowner, who requested anonymity, shared that most of her husband's salary now goes towards the mortgage, causing sleepless nights. The family moved into their new home in September 2021 with a variable rate mortgage, blissfully unaware that their monthly payment would soar from $3,050 to a staggering $5,250. The housing crisis isn't confined to just one family, it extends to others, like another neighbor from the same Oakville neighborhood. When he bought his house a year ago, he allocated only 27% of his monthly installment towards interest. However, within just a year and a half, a staggering 76% of his monthly payment now covers interest alone. The financial strain has forced him to curtail various expenses, including groceries, dining out, and after-school activities, leaving little room for vacations. Yet another homeowner from the area is also feeling the weight of the interest rate hikes. He currently pays an exorbitant $8,500 in interest alone for his house. Fearing that these rate hikes will not subside soon, he worries that he may be forced to sell his home and resort to renting, as working extra hours is insufficient to improve his affordability. The sentiment among many homeowners can be summarized by this homeowner's words: "Variable rate is killing. To be honest, we have to ration everything now, including cutting down on kids' activities." A local mortgage brokerage expert highlights how homeowners are grappling with the situation. Some individuals are able to manage their mortgages by making lump sum payments towards the principal or increasing their regular payments. Others, however, have had to take on additional work hours or extra jobs to keep up with their mortgage payments and retain their homes. The article raises the critical question of whether the shift away from variable rate mortgages and towards fixed rate options will continue to persist or if it's just a temporary trend. The uncertainty surrounding this debate adds to the prevailing crisis and panic felt by many Canadian homeowners. As the situation remains fluid, it is essential for homeowners to carefully consider their options. with the potential for further interest rate hikes and regulatory changes in the offing. The consequences for the Canadian housing market could be substantial. The risk of defaults and a surge in property listings poses a serious threat of a housing market crash, further complicating matters for homeowners already struggling to make ends meet. In conclusion, the article offers a comprehensive and detailed analysis of the financial challenges faced by Canadian homeowners due to the Bank of Canada's ongoing interest rate hikes. The personal stories shared by homeowners illustrate the gravity of the situation, prompting some to consider drastic measures to cope with the rising mortgage payments. As the housing market remains in flux, policymakers, financial institutions, and homeowners alike must navigate the uncertain terrain with prudence and foresight to avert a potential housing market catastrophe. The easiest option that many are not readily considering is to sell their home now before the market potentially crashes, and it will be infinitely more difficult to sell and avoid the increased financial stress. If the market goes down more than it is now, these financial stresses will increase exponentially, and trying to sell at that time will be next to impossible without drastically reducing the price. When you're financially stressed, the last thing you want to do is reduce your home's price in order to sell. What do you think? Should financially strained homeowners sell their homes now or wait for interest rate cuts? When interest rates are cut, will this mean that the economy is doing poorly, or will house prices and the housing market rebound? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.